Hey everyone, this is Kirk here again at OptionAlpha.com. Welcome back from the long Mother's Day weekend. Hopefully everyone had a great weekend. If you have mothers out there that you spend time with, I hope you had a great weekend. So I want to go over both the opening and closing or adjusting trades that we had for not only today, but the one tiny little trade that we had for Friday, because we didn't send out a video over the weekend. It was just one trade, so I figured I'd cover it today since it was a closing alert, not an opening alert. And anyways, there wasn't any point in doing it over the weekend because nobody was going to get into it on Monday since it was a closing alert. So let's start off with actually that one, and that is the AXP credit spread that we bought back. And again, this is on Friday of last week, so it's the only trade that we made on Friday. It's just one closing trade. But what happened is that we originally sold a credit spread in AXP, which is American Express, anticipating hopefully a bounce in AXP and a decrease in its implied volatility. Now, we had originally sold the 85, 82.5 put spread, and we bought that back today for a 5-cent debit. Now, you'll notice that this is also a May contract, so we're trying to keep rolling off those May contracts, which we continue to do later on this evening and today. But we did roll off that May contract. There's just a $5 debit. We could have easily just kept it all the way through expiration, but at this point, we don't want to risk the market turning back around. We had a nice profit book, so we just want to get rid of it. It was only one spread, so just two individual strikes, but booked a nice $50 profit on that. And if we go to the chart of AXP, you'll see that we actually had almost the exact move that we anticipated and wanted, and that was the move higher in the stock, and also implied volatility dropped down to the 2 percentile. So it was above 50 when we actually made the trade and dropped like a rock after earnings, which really just kind of goes to show you how quickly you can make money once implied volatility drops. Now, it doesn't always happen that IV drops so quickly, but in this case it actually dropped fairly quick in the couple days after earnings, and we just needed that move up in the stock to really kind of solidify the position going forward. The other trade that we closed out today is CVS. So I'm going to scroll down here so you guys can see this, but we closed out a trade today in CVS. We were long the 72.5, 75 call spread. So what we did is we sold that call spread back to the market. So we sold back the 72.5, 75 call spread, took in a nice credit of $345 and made an $80 profit on each of those that we sold back. So fairly nice profit on CVS. Really all we did was just get the exact directional move that we were anticipating in CVS. And you'll see the stock just made a huge move up in the last couple of days. And really, you don't really want to get in the middle of this and get in front of this and assume that the stock is going to make a continued move higher. So we have implied volatility at 0%, so it's about as low as it's ever been in the last year and a half. The stock has made the exact move that we think it was going to make, and made it in a very short period of time. So at least at this point, we don't want to do anything else besides just take money off the table. You don't want to risk the stock turning back around and coming back down, because right now it looks a little bit top heavy. And if I was looking at this chart, not having a position in CVS, I'd actually be a little bit more bearish than bullish in CVS just because of how many days in a row the stock has continued higher. We don't see a stock go this parabolic without showing some signs of weakness heading into a major uptrend. So at this point, again, best just to roll the trade off and book a nice profit. For Morgan Stanley, we closed out this one. This was a May contract that we closed out. It was one that just hasn't really solidified into a good position. And now that we're kind of in the last week and a half here of expiration, we really want to just get some of these positions off, take losses where we need to take losses, roll if we can roll. This is one of those examples where you just couldn't roll the contracts, the pricing didn't work. We covered that in one of the other videos last week, so if you need a refresher on rolling and looking at prices for rolling to see if it actually makes sense, check out that other video that we did just a couple days ago right here inside the membership area at Option Alpha. But in this case, rolling just didn't make sense, so we went ahead and sold back to the market our 30-33 call spread for a $25 credit. So we saved about $75 selling it back, but we did take a $123 loss on each of those contracts. So a little bit of a big loss on MS, which is Morgan Stanley. Really, at the end of the day, we just hope that financials would rally a little bit more than they did, and Morgan Stanley needs quite a big jump between now and expiration to get where it needs to go. So I just don't think it's going to happen now that we've had earnings go by. Pandora, this is one that we had kind of legged into an iron condor right before earnings, and earnings for Pandora was not too good. So earnings actually moved outside of our strikes down below the market. So Pandora is trading in the low 20s, and our lower strikes were at 26 and 25. So the market was actually in the money of our strikes on the low side. Now our call spreads are still going to be fine. we have the 26-27 call spread. Those are going to be fine and should expire worthless or practically worthless already. But we went ahead and bought back the put spread since we're in the money. We obviously have to buy this spread back or we're going to get assigned the contract. So in this case, we bought it back for a 90-cent debit. So it took almost max loss on this side of the trade. When we factor in all of the credits that we received, both the credit on this 26-25 put spread, the credit on the top side of the market, etc., we took a $46 loss on each of the iron condors that we had originally sold. So not too bad, and I'm glad that we actually hedged it for the market move because we originally had just the put spread, or I'm sorry, just the call spread, and we had the put spread. So at the end of the day, the hedge actually worked out just to reduce the max loss potential that we could have had on this trade should something have gone way worse in Pandora. So I really feel good about this position. As much as it is about making money trading, it's also about reducing losses and staying around to play the next trade. The last trade that we closed out here today is FXI. So FXI is another one that we closed out today to profit. These are June expiration options, but you'll notice that we sold back the 33.35 call spread. Now that spread is $2 wide. So the most that we could ever sell this thing back to the market for is $2. And we bought the spread for a little over $1. So today it was trading at 148. So we've made almost 35 to 40% of our max potential gain on this trade in a couple days. So we haven't even had this spread too long at all. It's been, I think, maybe a week and a half that we've actually been in this trade. So as far as the return on our money, we've made the vast majority of what we could potentially make in this spread very quickly. So what originally is a 50-50 bet, we are now taking off at a nice winner. So we sold it back to the market, all three of our spreads that we had for a $148 credit. So we took in a $35 profit on each spread. So it's about a $100 win that we took off the market. Again, with FXI, the market just made a quick little move higher, and that's all we were anticipating. So we just wanted the market just to jump up, and that's what we were hoping for, is just this quick little pop higher, and that's exactly what the market did. Again, we're not going to assume that it's going to continue an uptrend, which it may well. It may well continue in the uptrend, and for those of you who are holding, good luck with that. But you can see how jumpy FXI has been in the past, and it's a big China, large cap ETF, so it's going to be jumping all over the place and has quite a number of days that it gaps up and down all over the place. So at this point, we just didn't feel like it was worth holding on for the risk all the way through June. Now, if we get into some of the opening trade, or the opening trade that we had today, I got a lot of emails about this. And again, just as a reminder, I'm going to stop answering some of the just general questions in email that you guys send me, because I want you guys to add them to the membership section here on the blog. And let me just kind of scroll down real quick and just show you guys what that looks like so you can see. And you see we already have more than 583 comments since we added this just a couple months ago. So there's a ton of information that we have here, and I really encourage you guys to add your comments and questions here, because I get back to those much quicker than I get back to anything else. And email is going to be a lot slower because I get so many emails during the day with so many long explanations and people wanting me to review trades for them, which I obviously am never going to do anymore. But if you have questions or comments, I encourage you, ask them right inside the membership area here. Just join the discussion right here. It's really easy to sign up with this comment system. You can ask your questions, sign in with Facebook or Twitter or just your email, whatever the case is. But this way, a lot of other people can see the comments as well. And somebody that might have that same question, I don't want to answer it 6 times in email. I'd rather just answer it once here, and you guys can start a discussion amongst yourselves. So I'm really going to encourage that later on this week and start really kind of forcing the thing there with comments, because it's really just a drag on my time and your resources as well. A lot of the answers are already in the comment section. So getting back to this opening trade though, for XRT, this is a trade that we currently have in XRT. So this is one that was a custom trade, if you remember back a couple days ago, that we entered in XRT. And XRT had currently high implied volatility. And what we did is we had bought a call spread and then went further out in the market and sold a naked call against that call spread. And what that did was helped take our break-even price and move it $1 further beyond our short call spread. So you'll see that our short call spread is up, or our break-even price is up around 85 with the current position that we had before we added this hedge. Now what happened is that XRT has rallied very quickly against our position. So while the call spread that we are long is making money, the short call that we are short is not making any money right now. So what we did is we kind of recentered this strategy, and went ahead and sold a naked 84 put against this whole position and sold that for a $1.50 credit. So what that does is that moves the break-even point out another $1.50 on this overall position and really just kind of helps recenter the strategy. And I'll show you guys here in a second on the Analyze tab what I'm talking about. But by recentering the strategy, we kind of, again, get back to more of a neutral movement in the market so that if XRT moves up or down, we have an ability to take profits going forward. So let's take a look at where XRT is just right now so you guys can see we had a really quick move up in the last couple days right against our kind of break-even point out at 85. So it's kind of right on the doorstep here, and by selling the 84, now we kind of recenter the entire strategy right around 86, 84. So that's going to be a really, really good range for the stock to trade in going forward over the next month and a half here. If we actually go to the Analyze tab for XRT, and the system's a little slow right now, XRT. Okay, so here's the risk profile for XRT. And you can see it looks pretty much like a strangle at this point. Now we do have this long call spread, this 80, 81 call spread down here that we originally bought. And you can see the original short call that we sold is the 84 at 65. Now we went ahead and sold another 84, but it was a put instead of a call. So in this case, we have a strangle at 84 and then a long call spread at 80, 81. So giving us some positive movement in our profit and loss diagram. Now if I actually take off this short call spread that or short put that we added today, this is what our original profit and loss diagram looked like. So you can see that it's starting to move past the zero barrier and right towards our break-even price at 85. So remember, this is the zero line. This is the point at which we make or lose money above or below this line all the way across. And this red line is the line that we're concerned about, which is the line at expiration. So if it goes all the way to expiration, where do we make or lose money? Now you see that right now we start losing money every time that XRT trades above 85. So what we want to do is recenter the trade right around 85, right where it's trading right now, and kind of hedge our protection, right? We're doing really good on this side of the market, but we have a lot of risk to the top side of the market. So we want to give us something that has a little bit more juice to the top side, and that's a naked put in this instance. So by adding this naked put, and I'll go here and reactivate this short put, you notice that we now have recentered our strategy around where the market is. We still have some more exposure to the top side, but now we've moved our break-even point out to around 86.5. So we've added the credit that we took in today of $1.50 to our current break-even prices and moved it out from 85 to 86.5. So that gives us a little bit more room to be right, even on the top side. And you can see that by just making this adjustment, we still left ample room on the downside to be right in case XRT falls back or starts to retreat or whatever the case is. But we've also left a lot of room now, giving ourselves a good bit of distance between ourselves and the market now for just hedging purposes. And obviously now that we're extra short or short an extra contract, that means the time decay is going to be working 2 times as fast in our favor. Implied volatility, same thing. If we get a good move down in implied volatility in XRT in the next couple of days, which we're already starting to get because this thing was above 50 and now it's right at 39, then we should see a profit start to materialize a lot quicker. But you'll notice by moving our strikes out and by selling that put spread, our now break-even point is out at 86.5, which is about here. So we've given ourselves some extra distance between ourselves and the market in case this stock continues to rally up higher between now and expiration. So hopefully you guys really enjoy that hedge. I know this is a custom order that we continue to work with, and we'll continue to move around and play with it, but this is something that I've been wanting to do for a little bit here and used to do a lot of them and want to get back into these types of trades. They're really, really good trades and really good if you can hedge them properly going into them. They make a lot of money and seem to be very profitable. So as always, hope you guys really enjoy these videos. Ask a lot of comments or questions, not through email, right down here below in the comment section below this video. I'll get back to all of those tonight or tomorrow before the open, and happy trading.